The next gate is the at-risk limitation. A lot of times I think there's some, not necessarily confusion, but I don't think the at-risk limitation gets as much publicity as the basis limitation. And again, I've seen a lot of times the basis limitation just ignored as well. There was a form 7203, that the IRS has started requiring specifically S corporations to file, and the owners of S corporations to file with their individual returns. And so shareholder basis as it relates to S corporations has gotten a lot more, I would say, not necessarily publicity, but just attention from practitioners and from S corporation owners because of the requirement to file that form. But the at-risk rules are the second gate, and really the biggest difference are when you look at basis versus at-risk is there may be things that increase your at-risk that don't increase your basis. And so what's an example of that? The debt of an S corporation, right? And so I may not get a true increase in my basis for debt that I am personally guaranteeing that's debt of the S corporation, but that would increase my at-risk amount because, again, if the business were to fold, I personally guaranteed that debt, and so now I'm personally on the hook. So even though it doesn't necessarily increase my basis, it does increase my at-risk amount in some situations where there's a personal guarantee. So what can you do? The personal guarantee, make sure that you are at risk for that. You can look at non-recourse financing. And again, this is a specific type of financing specific to real estate where there may not be that personal guarantee that's on the line, but because of the way that it's structured, there is the collateral that can give you an increase to your at risk. One thing I do want to mention, and this is something I think gets overlooked as well when it comes to the at risk, is there is something called at risk recapture. And so what happens here is if you've got an amount that maybe you were at risk for and you deducted losses against that, and now your at risk amount drops below zero because you've either taken distributions out, that debt has gone away, then there is the potential for this recapture where maybe those losses that you've deducted in the past have to be recaptured as income. This is something that I think gets overlooked a lot, and especially if you're not tracking accurately your at-risk amounts, it's going to be really easy to overlook this. But again, something to be on the lookout for if that at-risk amount falls below zero. There is a form 6198, that gets filed that tracks this at-risk amount each year. So the third gate that we come to is the passive activity losses. So again, we've made it past basis, no limitations there, or maybe it's partially limited, but we've made it past gate one, we've made it past the at-risk rules, and now we need to look at, is this a passive activity or is it an active activity? Because if it's a passive activity, those losses can be limited as well. And so again, when we think about passive activities, it's typically going to be a trade or a business where you're not materially participating. And we'll talk about what that means. By default, most rental activities are considered passive, and that there are exceptions to that. Obviously, we've talked about that a lot on different webinars. Real estate professional, short-term rental are some of the ways that you can get around that, default classification. But sometimes that's going to be very difficult. Myself, I'm a business owner. I've got a full-time business that I'm running here with Oro. If you're a full-time W-2 employee, a lot of times it's going to be very difficult to meet the qualifications for something like real estate professional. It doesn't mean that real estate is not a good investment still. It just means that those real estate investments, if you're not a real estate professional or it doesn't meet the short-term rental rules, those will be passive by nature. If you're investing in a partnership in a limited partner capacity, that is going to be passive by nature as well. Any trader business where you're active, where you're materially participating, is going to be non-passive. So again, my activity and my investment in Oro is a non-passive activity. I'm participating in the business, I'm running the business, I'm operating the business on a daily basis. And so that is going to be a non-passive activity. And then you have a separate category that is considered portfolio income. And again, this is going to be your interest, your dividends, your capital gains, again, assuming that you're not a trader by nature. And then royalty income is also considered portfolio. So this is something too, just important to kind of point out that I think a lot of times people have a misconception about is they're like, oh, well, I've got this passive loss, but I've got a bunch of interest and dividend income that I can use that's passive income. Because again, you think about it, well, I'm not really doing anything to generate that interest and dividends. It seems like it would be considered passive, but that is a separate classification called portfolio income. And so again, to the extent that you have portfolio income, you cannot use a passive loss to offset portfolio income or to offset non-passive income like W-2 income or active business income. What are those material participation tests? There's 7 tests. As long as you meet one of these, then you are considered to materially participate. And again, as it says there, the first 3 are typically the ones where it's going to be very cut and dried. If you meet one of those 3, then you're pretty much in the clear. If you don't meet one of those 3, then you can meet one of the other 4. But again, a lot of times if you look at something like, for instance, test number 7, based on facts and circumstances, you don't want to rely on test number 7 to meet the material participation test. The first 3 are kind of where most people focus, and if you meet one of those, then you should be in the clear when it comes to material participation. That's the threshold to get over. Once you get over that, then the activity is no longer considered passive, and you're not subject to those passive activity losses, passive activity rules. And that's the important thing to think about, right? Because again, if you've got real estate and maybe let's just use me as an example. I've got income from Moro and it's $100,000. And I've got real estate that I've invested in that has $100,000 of losses. If I'm not active in that real estate activity, those losses are just going to be limited because I don't have other passive income to offset those. So they're going to continue to carry forward until I either have passive activity income to offset it or I dispose of that property. So again, it's very important to be thinking about that as you go throughout the year. Hey, I've got plenty of basis. I'm at risk for the loss. I'm good there. But is this a passive activity? And if so, what can I do to either make sure I'm materially participating, or maybe I should invest in other passive activities that are generating income? And so that's, again, what are some moves that we can do to offset this? Material participation, real estate professional status. That's a whole nother webinar we won't go into today. But again, many of you are familiar with that. Again, we talked about disposing of the property. So if I've got real estate that has passive losses built up, if I dispose of the property, those losses are then freed up. But one of the things that I think people don't think about is, hey, maybe I should invest in something that's going to generate passive income. Because if I have a business that I can invest in that I'm not going to be active in, but that's going to generate profit each year, and then I have another business or real estate or whatever that I'm invested in that's generating losses that are passive in nature, I can use passive losses to offset passive income. So that's one strategy to use is, hey, I'm gonna invest in something that's going to generate passive income because I know I have passive losses that I can use to offset that. There are there's elections that you can use to, for instance, group passive activities with other active activities. The typical most common one there is if I've got a business that I'm operating and I have a real estate that I own, so self-rental. I'm operating my business out of that real estate, but I own it in a separate entity for asset protection purposes. You can group those activities together. And so what may be passive if you're looking at it on a standalone basis, if you group it with another activity, and again, it has to be a substantial grouping, meaning it has to make sense. Like I can't just group it because I want to for tax purposes. But again, that may be a way to get around some of those passive activity rules. And then again, for rental activity specifically, there is a special $25,000 allowance. And if your income is below a certain AGI level, then even though it may be passive in nature, you can deduct up to $25,000, again, assuming that your income is below those AGI levels.